right. What is up? And welcome back to another episode of How to Invest in Commercial Real Estate.
What's up? Yeah.
Fun weekend. Christmas party last night.
Yeah, that was great.
Christmas party. That was fun.
There's a lot of booze left over at my house.
You're welcome.
Yeah, thank you.
Yeah.
Well, we'll head over there after the podcast.
It was good for my kids to see that there was booze left over because when they saw the amount of liquor that was there, they're like, Mom, Dad, that's enough for a village. I'm like, yeah, we like to have a little extra. I mean, we didn't drink it all.
Yeah.
Watched the Thunder dominate without Shea. That was incredible.
Yeah. 11 3-pointers in the first quarter. New Thunder record. That's insane.
Shot 50% from three. Won another game by 30, 23-1.
23-1, yeah.
7 different players made a three-pointer. And then they had 7 different players make an assist. 4-shot. I mean, the ball movement they have is incredible.
Yeah. We get a lottery pick next year.
Oh, we are. We're going to. And so, people might have made fun of me last year when I made the comment that we had an argument for the best team ever. Won the championship, one of the best records ever, and the highest point differential ever. This year, we're have the highest point differential ever again, and we are on the verge of potentially having one of the best records ever. So, Thunder dominating. All right, update. Got a little year-end update for you guys today.
Yeah. We were doing the math for a little speech at the Christmas party, and we realized how much real estate we bought this year. It was kind of mind-blowing for me. I thought we ended at like 50, 60, and it was $72 million. $72 million. Nice. $21 million of equity, of cash equity we raised this year. Wow. And it's, a week into December. So that was all done in really
11 months.
Yeah, 11 months. So $2 million a month almost.
Oh, that's crazy. No one knew where this was going to go when you guys started this. 2019, bought your first deal, $4 million, $1 million, roughly in equity. And that was mostly I put in, Braden.
Yeah, it's like 6 investors, 6, 7
investors,
families and friends.
And so 6 years later, we 20x'd.
Yeah, it's amazing.
We went from 1 million equity raised to over 20. 4 million in real estate purchase to 72, almost 80, so almost 20x. I mean, it's been amazing.
A lot of the same investors as the first few deals. A lot of new investors. It's kind of crazy, actually.
We started with a handful, okay, and now we have hundreds, hundreds and hundreds, and thousands, I think, on the list.
Thousands,
not active. They're not all active, but eventually we hope to convert them. And I would say it was done through not quite the easiest of time periods to invest in commercial real estate.
Yeah.
I mean, we had a couple of years there where the interest rates were really low, and since 2022 they've been super high.
Mm-hmm. And nobody did anything in 2020. I mean, from January to October.
Yeah,
I sat on my hands.
And so I would say that 6-year period, to be able to 20x during this 6-year period, makes it even that much more impressive that we were able to do that. Because I think if we hit our stride, and let's say we'll talk about it later, but the market corrects and interest rates come back down, should be a really good time to be able to acquire a bunch of real estate.
I mean, we've been going at it 6 years. If we can do 75 or it would be amazing next year if we do $100 million a year. If you rack a few of those together, that's a lot right there. You do 5 years of $100 million a year, that's $500 million worth of real estate, man. So it's nuts. And we're still buying retail centers. We're still buying stuff that looks exactly like the first deal. That's kind of what blows my mind is we're not out here doing crazy stuff. It's the same stuff. And there's more of it. I think we can easily buy $1 billion worth of neighborhood strip centers. Yeah.
The last one we bought looks a lot like the first one we bought.
It really does. Anyway, exciting stuff. Thanks, everyone, for believing in us still in the beginning now.
So kind of the topic for today is we're going into 2026, and we wanted to kind of get you guys thinking about a potential market crash. And, nobody likes to talk about that, but when we look at history, every 7 to 10 years, we really have some type of market correction or crash. We had one in 2000. We had one in 2008. I don't really count 2020 because
it should have happened. It was just stopped.
Yeah, it was start to crash only because of fear of a global pandemic. It wasn't, that the market was crashing on its own because of the fundamentals. And then the Fed stepped in and printed trillions of dollars. Not only did it wipe out the crash, but it created a boom in asset values.
That was really the artificial thing. Arguably, nature was taking its course, whatever that was, and then we stepped in and said, "Oh, let's lower the debt. Let's give everyone money."
Yeah,
and we kind of artificially, like Brian said, maybe delayed it, stalled it, stopped it, whatever you want to use.
And so what we see now, and I think Brian has got a couple numbers for us, but we see some crazy ratios going on that indicate that maybe there's some bubbles building in the market. And I don't think that that's going to be disastrous for commercial real estate. Commercial real estate doesn't move like the markets move. It will create some challenges, but we just want everybody to be prepared as far as their stocks go and some other things. So let's talk about
Bonds, real estate.
Brian, hit us with the numbers.
All right. Well, where do you want to start? You want to start with the S&P 500?
Sure.
Right now it's at about 6,800.
Yeah.
And let's see, at the lowest point in 2008, it was 660 basically. So it's it's 10x'd since then.
So yeah, 1,000% in 16 years, because that was really the end of 08. So really the beginning of 09 to the end of 2025. That's 16 years.
Timed perfectly, like you said. A month on either side of that, and a lot of different results here.
But I'm just saying the market's supposed to do an average of 9%. But I mean, now we did 1,000% in 16 years.
Yeah.
That's really crazy. So let's do the Dow next.
Well, I don't have the Dow. I have the NASDAQ.
Well, I'll do it for you since I do kind of have it.
Okay.
Dow is 6,500, I believe, in March of 2009. And I think the Dow today is over 43,000, 45,000. I can't remember.
Okay.
And so what is that? That's almost an 8X on the Dow, which you would think the Dow wouldn't go as high as the smaller cap companies. And so then we got the third one, NASDAQ. So the NASDAQ after the crash was what?
About 1,265.
And today?
23,500. So that's
remind me what the NASDAQ is. Is that the top
tech
100?
stocks.
Tech stocks.
Yeah,
Okay.
yeah, basically tech stocks.
Guys.
So 20x.
20x.
That's dumb.
In 16 years.
Yeah.
Guys, that's almost doubling, every 2 years. I mean, that is crazy. So if you don't think that there's any type of a bubble happening in the stock market right now, that we've 20x the NASDAQ in 16 years, 10x the S&P in 16 years, I feel like there's risk in the market, right? We're at all-time highs, but we were at all-time highs last year and the year before and the year before. We just keep setting new all-time highs. At what point do you come to the realization that a big market correction is inevitable?
It's got to be. We're like more than double the time length, right? Every 7 to 10 years. When was the last one? 2008? We're 16.
Yeah, people will call 2020, like I said, they're trying to call that a crash, but it really wasn't. It was a month-long dip, and then it came right back up, and it was so. Anyway, we have a couple other kind of indicators that suggest that potentially other sectors of the market are in a bubble.
So right now, the S&P, the average PE ratio of the S&P is 28, and the other highs historically were in 1929. They were at 32.6, and the dot-com bubble of 2001, it was at 27.5. So PE ratios are really high, and they're about at the same levels as they were in 1929 and 2001.
And explain PE ratios for dummies.
So stock price over earnings, and so you have a set of earnings, but how many times more is the stock price than their earnings? And so that's valuing the company at really high multiples, basically.
Yes, you're paying $46 in value for every buck, or what was the average? 26?
28.
28.
So you're paying $28 in value for every dollar in earnings.
Yeah.
Which
historically is really high. I don't know what typical average would be, but I know that's high.
Really, really high. Okay, what are some other metrics?
So there's a Buffett ratio, which is market capitalization over gross domestic product.
Okay.
And so according to Buffett, anything over 120% ratio is dangerous. During the dot-com bubble, we were at 145%. In 2008, we were 135%, and today we're at 185%.
Ouch.
And that was what the Buffett ratio is. What exactly?
It's market capitalization divided by gross domestic product.
Oh, geez.
And so once again, that's pointing to the values of the companies.
They're surging so high without the actual sales and revenue coming through. Like they're appreciating just ridiculously fast. Mm-hmm. And for example, an 8 cap, you're basically exchanging $8 in value for $1 in return. You know, right?
12 actually.
Okay, 12.
Yeah, an eight cap, it's be 8% return, but to get to the value of the asset, you have to take it times 12.5.
Okay.
So
like half.
Yeah.
So get this. So we talked about the PE ratios of the average, but there's something called the 7 magnificent stocks. It's Amazon, Microsoft, Nvidia, Apple, Google, Meta, and Tesla, which make up 30% of the S&P 500. Their average PE is 45.
Oh my God.
I believe it. Tesla's like 50 or something stupid.
Yeah. So I
Nvidia's
think it's even higher. Yeah. So 7 stocks make up how much of the S&P?
30%.
30%, and 30% of the S&P is at PE ratios at an average of double what the market PE was during several of the crashes in our nation's history.
Right.
Which means the market is pricing in more appreciation. They think it's going to continue to go up. It has to.
That's what that means. Yeah.
So it's
that happens
kind of
or not.
nuts. So in order for this to, be a lot of equity needs wiped out is what we're saying, right? For this to be balanced out.
Yeah, to get back to the average.
And we realize, guys, we don't have an expertise on this. This is not our area of study. So we're bringing kind of
high speculation.
Idiots talking about potential market crashes. Okay, that's what you're getting today.
Let's look at Joel's crypto advice from a month ago.
That's right.
The opposite of that. So next year could be the best year we ever had.
Well, I do believe that 2026 could be a boom year. But I think towards the end of 2026, 2027 is when I think we could see a big, correction. I don't know if that's going to happen or not. All we're doing today is talking about, if you're not paying attention to these metrics and these 20x on the NASDAQ over the last 16 years, if you're not paying attention and once the market continues to go up, you're just like, I can't lose. Get ready to lose. You have to just at least be aware that these are riskier times to be buying stocks than normal. And I think even the home price index is way above mean at this point.
Yeah, right now we're 50% above the trend line over the last few years. So we're way overpriced on
housing.
Yeah, which everybody knows that, right? You probably know some statistics on this too, Joel. I've heard you saying before, but right now our debt is $36 trillion and our payment on debt is $1.2 trillion a year. And that's way high, isn't it?
It's so high, guys. We may not recover.
I think it's more than the national defense budget.
Yeah, and if it isn't, they're very, very close. I mean, it's close to the largest line item in our nation's budget. Yeah. And look, I don't care what side of the fence you are politically. Okay, you're never going to solve this problem without doing 2 things, which is cutting spending, which nobody wants to do, and raising taxes, which nobody wants to do. And each side wants to do one of those, but not the other. And so we stagnate. And so we in some sense, lower taxes, which only reduces revenue. And then the spending keeps going up. And so that deficit is just growing out of control. I remember as a child in the early 90s, George Bush Sr. was the president. And I believe our national,
we're going way back.
Yeah, I believe our national debt had reached $3 trillion in the early 90s. And I remember adults in my circle were talking about it and saying, we're just never going to pay it off. This is astronomical. It's terrible. $3 trillion. We're $36 trillion, guys, in debt today. And so I really do think that's going to be a problem. It may not be a problem a year or 2 from now, but as it balloons, it will become a major problem going forward 5-10 years from now.
It is interesting, everything going on with the tariffs, though, because they're not 100% dropping down to inflation. It's not going straight to the consumer. A lot of the businesses so far have picked up a decent amount of tariff revenue. So it'll just be interesting. You got to do something. At least it's more revenue, and it's not just all hitting us so far.
Yeah, that's above my pay grade. Inflation was working its way lower. Did they kind of stagnate that a little bit? I don't know. Inflation is still relatively low compared to what it was.
So what do we think as far as real estate? Let's say that
World's over. Sell everything.
That the stock market crashes, or maybe and then they start printing some more money, and inflation takes off. What does that mean for real estate? Are assets in real estate decline as well, necessarily?
Good question. I'll let Braden hit it first.
Yeah, I think if we experience another hyperinflationary, moment like we did because everyone's giving out money or we're lowering interest rates to try to artificially prop it up, it's going to make asset values surge. Go up. I think in the short term, if the economy is going through a lull and the market is going down, asset prices are going to have to go down. But I think the beauty of commercial real estate is it's super liquid and you don't have to paper that loss. You just hold it until the market turns. So if anything, it's probably a good time to pick up some more deals. You can probably find some more deals, distress assets, somebody being forced to sell, whatever it is. But I think they have to go down, but depending on how they deal with the crash politically,
interest rates could go down, right?
Interest rates going down is gonna push values up. Right. If interest rates go down, there's several properties I would like to sell just because you're getting peak value there.
Yeah. So my take on it is this, like you said, Braden, we're very illiquid in commercial real estate and it's a very slow moving asset class. And so if we have a crash, I believe that what we're going to face is businesses going out of business.
Yeah.
Okay. Because, the economy slows, less people start businesses, maybe less people spending money. Therefore, businesses that are in our retail centers struggle.
Maybe rent growth stalls out a little bit.
Yeah. And so our focus would be on making sure we have enough cash to withstand some of the, losses of tenants, increased vacancy. But as long as you can stomach that and you don't have just a mass exodus of tenants, when we have a crash, interest rates are going to go down, and that'll allow us to refinance our debt lower. And that will help us kind of sustain through the crash until the economy starts picking back up. And so for us, I don't see commercial real estate as risky, nearly as risky as stocks. I think stocks will take a huge hit when this crash happens, whatever that is. I mean, typically you lose 30 to 50% of the value.
I can't see
it's
real estate.
Because you see it, right? Like if somebody measured our real estate with a 24-hour market, there would be huge dips and swings based on a tenant going out or whatever, but you just don't value it that way.
Yeah, right.
Like when the market goes to hell in a handbag and you miss the boat on selling, just don't look at your account until 5 years from now. That's just what you got to do unless you're buying more. You just don't look at it. It's not a loss. It's going back up, probably. Unless it's, Neiman Marcus or something. I mean, there's going to be some bad bets in there, but generally speaking, the loss is not papered unless you have to sell. So you really just got to gut through it and wait until the market turns. If you've got cash, which I know the last episode we were like, cash is garbage. If you've got cash, when the market goes down, that's when you buy in. King. Yeah, that's when you take advantage of these 20x opportunities. Buy some NASDAQ. This is what it sounds like.
Well, one thing I like about our strategy, and we'll kind of conclude with this, is that we are higher cap rate buyers and therefore higher cash on cash buyers. And so inherently we have a little bit more room in our profit and loss to withstand some tenants moving out before we get to a sub break even, losing money type situation. And in real estate, that's really what you're focused on avoiding, is not being able to make your mortgage payment and having to hand the property back to the bank, in which you would lose all of your equity. So as long as we can avoid that situation, we're going to be well positioned to do really well when the market crashes, because assets will go on sale. There'll be foreclosures, some people that weren't as careful, and we'll be able to pick up assets on the cheap, get really low interest debt, ride it out, and then when the market comes back, we'll be really in the profit. So that's really our strategy. Once again, we're not trying to predict here. We're just saying that looking at the numbers, it's inevitable that at some point we have a correction. And I think it'll be late 2026 or early 27. But obviously, I don't always predict correctly because I jacked that crypto prediction up. So,
I think it's important. You're not waiting, right? Like you're conducting normal courses of business. You're buying, you're selling, but it's just when the market goes down, you're buying more, right? When the market goes up, you maybe sell a little more. But normal, like we bought $70 million worth of real estate this year. Last year we bought 55, and a lot of people haven't, they really slowed down and are just now starting to pick back up. So you buy through every season. You may just buy more in some seasons. You may sell more in some seasons. So don't wait.
Averages out.
Waiting for the perfect time, you're going to get screwed every time. You just gotta keep going.
Yep.
Anyway, we'll see you guys next week.
Okay.
yep. Thanks, guys.